Welcome to Stock Genius. Today, let's dive into some surprising news. Did you know that Netflix, Apple, and other major companies have recently announced stock splits, but not in the places you might expect? Yes, you heard it right. These business giants, including International Business Machines and Bank of America, have chosen to split their stocks. It's a fascinating twist in the world of stocks, with lessons we can all absorb from this international dilemma. To get a clearer picture, let's take a step back and recall some earlier events. This week, smartphones were filled with news from the stock market information services. They announced that Netflix, surprisingly, split its stock. You might wonder if this announcement was hidden within an earnings report. But wait, the same thing happened with International Business Machines, Bank of America, Apple, and Toyota Motor. However, something doesn't add up. These corporations couldn't have possibly executed stock splits simultaneously without making headlines. Interestingly, these stock split announcements were absent from the usual American stock market sources. So what's the real story? A detailed inspection of the stock tickers gives us the answer. Stock splits were not about the American stocks at all. They were related to each company's presence on the Argentinian stock market, the Buenos Aires exchange. Indeed, Netflix and Apple did split their stocks this week. However, it wasn't because their listings on the NYSE and NASDAQ exchanges were becoming too expensive. Although they may reach that point soon, the story is different on the Buenos Aires exchange, where investors are dealing with Argentina's extreme hyperinflation. At this point, Netflix trades at roughly 14,700 Argentine pesos per share after Wednesday's 3-for-1 stock split. That's approximately $18 at today's exchange rates. However, Argentina's financial situation is unpredictable. In early December, the same amount of pesos was valued at $41. A year ago, it was $79. It's no shock that American companies feel the need to adjust their share prices in light of this devastating exchange rate trend. What caused these giants to go for stock splits on the Buenos Aires exchange? Let's delve deeper. If you find our content helpful, don't forget to subscribe, like, and share our videos. It's important to remember that we are not financial advisors. We provide purely educational and informational content here at Stock Genius. The root of these surprising stock splits lies in Argentina's severe hyperinflation. You see, Argentina is grappling with a crippling economic crisis, and at the heart of this crisis is a hyperinflation issue that is wreaking havoc on the nation's economy. To fully understand the gravity of the situation, let's take a closer look at the Argentine peso's value compared to the US dollar. Picture this. In early December of 2023, a stash of pesos that was worth $41 was worth only $18 by the end of January 2024. That's right. The value of the peso dropped by more than half in just a month. And if you think that's shocking, consider this. The same stash of pesos was worth $79 a year ago. That's more than a 75% decrease in value in just a year. It's a roller coaster ride, and not the fun kind. It's more like a never-ending drop that makes your stomach churn and leaves you feeling disoriented and a little queasy. This is the reality of hyperinflation. The prices of goods and services skyrocket while the value of the currency plummets. It's a vicious cycle that feeds on itself, creating a downward spiral that is incredibly hard to break free from. Now you might be wondering, how does this relate to the stock splits we talked about earlier? Well, as the value of the peso continues to drop, the price of shares listed on the Buenos Aires exchange skyrockets when converted to pesos. This is why Netflix, Apple, IBM, and other American giants decided to split their stocks on the Buenos Aires exchange. Let's take Netflix as an example. After a 3-for-1 stock split, Netflix trades at roughly 14,700 Argentine pesos per share. That's only about $18 at the current exchange rates. But given the speed at which the peso is losing value, who knows what that'll be worth next week or even tomorrow. For a comparison, let's take a quick look at the US. In June 2022, the US dollar's inflation rate briefly soared to 9.1%. It was a significant jump, that had a considerable impact on business and personal finance, prompting anti-inflation policies from the government. But compared to Argentina's situation, it's a drop in the ocean. In Argentina, December's prices were a staggering 25.5% above November's and 211% higher on a year-over-year basis. That's the stark reality of Argentina's hyperinflation crisis. And this catastrophic exchange rate trend has forced American companies to adjust their share prices on the Buenos Aires exchange. It's a stark reminder of the interconnected nature of our global economy and the ripple effects that a crisis in one country can have on businesses around the world. So, how does Argentina's hyperinflation impact these stock splits? To understand this, let's first delve into the concept of a stock split. A stock split is a decision by a company's board of directors to increase the number of shares in circulation by issuing more shares to existing shareholders. In essence, it's like dividing a pie into more slices. The pie hasn't grown, but there are more slices to go around. Now, why would a company choose to do this? Typically, stock splits happen when the price of a company's shares has risen so high that it becomes unwieldy. By splitting the stock, the company makes each share more affordable, encouraging more trading and liquidity. But that's not what's happening here. Take Netflix as an example. In the United States, the price of a Netflix share hasn't skyrocketed to a level that would typically warrant a stock split. However, in Argentina, due to the country's hyperinflation, the price of a Netflix share in Argentine pesos has shot through the roof. Imagine you're an investor in Argentina. One day, you're buying a share of Netflix for a certain amount of pesos. The next day, due to hyperinflation, that same amount of pesos is worth significantly less. As the value of the peso drops, the price of a Netflix share in pesos skyrockets. This is where the stock split comes into play. By increasing the number of shares available, the price per share drops, making it more affordable for investors, even with the hyperinflated currency. It's a way for these companies to adjust their share prices to accommodate the rapidly changing value of the Argentine peso. This is a starkly different reason for a stock split than what we usually see. It's not because these companies are doing exceptionally well, their share price is soaring to new heights. Instead, it's a response to an external economic crisis. The companies are essentially trying to keep their stocks affordable and attractive to investors in a market that's being rocked by hyperinflation. It's important to note that these stock splits are localized to the Argentine market. They do not affect the price or number of shares in other markets, such as the United States. This situation underscores the interconnectedness of today's global economy. A crisis in one country can have ripple effects on companies around the world. It's a reminder that when we talk about the stock market, we're not just talking about Wall Street. We're talking about a global network of exchanges and economies, all intertwined. These stock splits are, therefore, not a reflection of the company's soaring value, but a response to an international crisis. It's a curveball from the world of finance, showing us that the stock market is always full of surprises and that economic forces can shape the strategies of even the largest multinational corporations. What can investors learn from this unique situation? Well, the Argentine stock split saga is a potent reminder that we're no longer playing on a local stage. The global economy is interconnected in ways that are more profound than ever before. A crisis in a distant land can send ripples across the world, affecting your investments. When we think of investing in stocks, we often think of the company's performance, their quarterly earnings, and their future prospects. However, the Argentine story underlines the importance of considering the broader economic environment. It reminds us that the performance of a stock isn't just about the company's financial health. It's also about the health of the economy in which it operates. This is where the concept of diversification comes in. It's an age-old wisdom in investing, but it's worth repeating. Don't put all your eggs in one basket. Spread your investments across different companies, sectors, and yes, countries. Diversification can help cushion the impact of unexpected events, like a sudden bout of hyperinflation in a far-off land. But diversification alone isn't enough. It's equally important to stay informed about global economic trends. What's happening in the world economy? What events could potentially shake up the markets? These are questions that investors need to ask regularly. Take the Argentine crisis, for instance. It wasn't a sudden event. The signs were there for those who cared to look. The country's inflation rate had been soaring for months. An informed investor could have seen the writing on the wall and adjusted their strategy accordingly. And let's not forget the importance of reliable information. In a world where news travels at the speed of light, staying informed is no longer optional. It's a necessity. So make it a point to subscribe to reliable news sources, financial newsletters, and market analysis reports. In the end, investing is about more than just picking the right stocks. It's about understanding the global economic landscape and navigating it with a well-informed strategy. Investors must stay informed about global economic trends to make savvy decisions. Let's summarize what we've learned about these unusual stock splits. In a surprising turn of events, business giants like Netflix, Apple, IBM, and Bank of America announced stock splits. But these splits weren't a response to a rise in company value on Wall Street, but rather a reaction to the severe hyperinflation crisis in Argentina. The splits took place on the Buenos Aires exchange, not on American soil. This unexpected move underscores the influence of global events on our interconnected economy. It highlights the importance of diversifying investments and staying informed about international financial trends. The Argentine crisis is a stark example of this. It's a situation where the inflation rate has gone beyond control, with December's prices soaring 25.5% above November's and 211% higher on a year-on-year basis. This rapid inflation has significantly impacted the value of American companies' shares in Argentina, necessitating the stock splits. For instance, Netflix, which trades at around 14,700 Argentine pesos per share, after a 3-for-1 stock split was worth $79 a year ago, $41 in early December, and is now worth just $18. This is a clear demonstration of how swiftly things can change in the face of severe hyperinflation. The U.S. had its own brush with inflation, with rates soaring to 9.1% in June 2022, triggering severe anti-inflation policies. But the Argentine crisis is far more severe, reminding us of how crucial it is to be aware of global economic trends and their potential impact on the stock market. The key takeaway here is that the stock market is not an isolated entity. It's a complex network intertwined with global economic conditions. Events in one part of the world can ripple across the globe, affecting investments in unforeseen ways. Remember, in an interconnected global economy, events in one part of the world can have unexpected impacts on your investments. Stay informed and stay savvy.